Ständiga all-time highs på Wall Street får nog några att fråga sig om Europa verkligen är en så bra idé i portföljen. Med oss för att diskutera detta har vi Karen Ward joining us from JP Morgan Asset Management. Wonderful to have you in Stockholm.
Good to be here.
Going into the year, we were told that Europe is the place to be essentially, but as I said in Swedish just now, the Wall Street keeps on beating the records, new all-time highs every day. So does this Euro preference still hold?
I think it does. I mean, particularly when we think about where expectations are today. Expectations on the US are for everything to work out perfectly. AI will be transformative. The Fed will be slashing rates. There could be some disappointment there. I think expectations about Europe are still pretty modest. So there is scope for upside surprise. And when you're investing, that's what's really important, is where could we learn information? And I think it's going to be hard to learn things are even better in the US. But we're going to learn, I think, that actually our recovery here in Europe has legs. Corporate earnings growth is going to pick up. And so I think you stay with it. And most importantly, you have to think about the currency today. When we translate what's going on into our local currency terms and take into account the 10% decline in the dollar, then that really plays into why, particularly if you're unhedged, a European focus is the way to stay forward.
So my presumption going into this discussion that Europe has actually not performed very well is not right. If you take currency into consideration, it looks good.
Absolutely. If we take what the currency continues to do, the dollar continuing to decline, then Europe's outperformance has continued.
I want to talk more about the dollar's continuing decline. But before we go there, sector-wise, if you've been in European banks, you've been very happy this year. Do you have any thoughts on sectors going forward, or this is more of a broad assumption?
I think it will be reasonably broad, but I think there are sectors where, again, coming back to my point about where are we going to learn upside, I think there are sectors where some of the support that's going to come from governments, from the Commission, isn't yet in the price. And actually, that's some of those sectors that have been struggling. Autos, the industrials. I think as over the next 18 months, we're going to learn that governments are really focused on supporting these industries that have really struggled for the last 10 years. And that's where I think there are still some opportunities.
Might be a bit of a dollar headwind. The dollar has come down quite a lot. It's a problem for the Swedish industry because we export a lot. Any thoughts on that? And could you talk some more about your view that the dollar will continue to decline?
Yeah, I mean, let's think about why the dollar was so strong. It was strong because the economy was outperforming. Therefore, interest rates stayed higher and were attractive, and the stock market was outperforming. And underpinning all of that was this institutional framework that you had full faith would maintain the value of the dollar. Now, what is changing is growth isn't outperforming as much as it was. Interest rates are coming down in the US. That differential wasn't there. And as we talked about, investors are looking for other opportunities around the world. So that capital is moving, but it's moving slowly. And that should be, therefore, ongoing, orderly decline in the dollar. There are disorderly risks, however, which investors are monitoring, and they are particularly around that institutional framework, particularly demonstrations the Fed are going to really fight inflation and maintain the value of the dollar. But I think overall it should be slow, disorderly, but ongoing. Now, as you say, for us here in Europe, that could be a problem. So this is then, I think, going to lead to the next leg of stimulus here in Europe. And particularly it's going to bring the ECB and our central banks here back onto the table with cutting rates even more to try and support the European region. So it's going to be the next leg to that European stock story also.
That does sound appetizing for European stocks. I want to talk more about inflation risk, but you mentioned diversification. All right, we like Europe. We like Europe broadly. We like the industrial sector. But any thoughts on diversifying your portfolio away from equities, perhaps?
Well, we have two big risks on the table. One is that AI doesn't prove to be quite as exciting as the market currently thinks. And we've already talked about how geographical diversification is going to protect you from that risk. But the other big risk on the table is inflation. And what we learned in 2022, that when inflation is the problem or governments are misbehaving, trying to spend too much money, both stocks and bonds go down. So how do we put together a portfolio these days that protects us not only from recession risk, where bonds will still work, core bonds, but protects us from inflation? And that's where 2022 taught us life is more complicated. There are fewer places to hide. The best ones are in alternatives. Things like transportation assets, timber, core infrastructure. And I think for investors stepping away from the short-term noise, the key thing to get right is to think about these days, what is a diversified portfolio that protects me from the new risks that are on the table? How does that look? And it's very different, I would argue, to what it looked like 5 to 10 years ago. And it's much more alternative heavy.
Oh, it's quite interesting. I think that's why a lot of people have chosen to invest in gold, which is breaking new records all the time. The same reasoning, you want something else that's protected against inflation.
That's exactly right. I think, however, we would argue that there are other assets outside of gold that give you a nice, healthy yield in normal times without even when inflation's not causing you problems. So things like your transportation, core infrastructure, you're getting a high single-digit yield in the normal years. So that's why we find that a little bit more enticing than gold.
Quite interesting. You would have to look at private equity structures or something like that to access these assets. So not quite as easy to find as stocks.
They're illiquid. There's a price to play. Absolutely. A lot of these assets, you are giving up liquidity, but I think that's something we have to suffer for the sake of having assets that really do perform in this environment.
Let's finish off. You mentioned inflation risks a couple of times now. When we're recording this conversation, the Fed meeting is coming up. Obviously, easing down the line. You mentioned the ECB easing and stimulating as well. How worried should we be, and how near is this threat of inflation?
Well, if we step back and think about what's going on in markets at the moment, markets are very happy with the fact that we have government spending money with no real ambition to reduce deficits across the world, and central banks increasingly also putting their foot on the accelerator. So we've got monetary and fiscal policy putting coal into the engine, and that's moving risk assets along. Now, what tells us that that has to stop? And it's inflation. So that is the key risk for us working out at what point do we dial down the risk. It's not at the moment, because it's very clear the coal is going in the engine and the engine is moving fast, and you don't want to miss out on that. But inflation is going to be that key sign that tells us, okay, maybe this is going too far. Maybe that monetary and fiscal coal has to slow down. So that's the key watch item through year end.
Risk on is still reigning, but diversify now and keep an eye on inflation. That's the key that will tell us that the party might be over for now.
You've summed it up perfectly, Gabriel.
Wonderful to have you here in the studio. So nice. Karen Ward, thank you very much.
Thank you.